webinar. We'll be starting in a few moments. In the meantime, just hang back. We're about 3 minutes ahead of the hour, and I'll start in a couple of minutes. But thank you all for attending. Look forward to this. Hopefully you are too. So we have our moderator, Dwight, with us. Dwight's in Jamaica these days. Everything copacetic over there, Dwight?
Yeah, it's going good. It's pretty cool.
Have you got this new variant over there?
We've heard of one case so far, so I'm assuming that's going to increase.
This whole thing's pretty benign. I think it's been really, I think we're going to be living with this thing for a long time, and
very, very long time.
We have to pick our wars. You can't get bent out of shape every time there's something. Especially this one seems very benign. It seems like the Delta is still much more complicated.
Yeah, I think this thing is just going to keep mutating and changing as the vaccines get more prevalent and such.
So I'm not sure. Somebody asked, will there be a replay? I'm not sure. You can always message our support if you want a copy. I'm going to put a link to our support team in the chat box here. And if you sign up and want to know anything about your account, just this is the email. So message the email if you want a replay, and they'll send it to you if there's not one available. So I'll give this another minute. How many? We've got 186 people in here. So fantastic turnout. Hey, Dick. Got Dick Mast here. Dick is a very loyal enthusiast member. Always hangs around, never gets sick of hearing from me. So thank you for that, Dick. Got John Marsh. So welcome, everybody. No, thank you, Dick. All right, so I'll give this another minute. Got a lot of people who checked in ahead. We're almost at 200, so fantastic turnout. Hopefully I can live up to the expectations. Had a fast and furious couple of weeks. Actually, it's been an amazing year. I've had an amazing year. Called some markets pretty bang on the spot. And hey, Vera. All right, so we have over 200 participants. So why don't I get started? So welcome to this webinar. This is a live 4-day trade execution webinar series. I've kind of subtitled it, How to Capitalize on Monster Moves in the Markets and also avoid, hopefully, the potholes that come along with it. My name, again, is Mark Shaws, and the Pattern Trader. A lot of you on here already know me. For those that don't, I'm just going to digress, give you kind of a brief background on who I am, where I came from, how I came to do this crazy business. I started trading more decades ago than I care to acknowledge or remember. I was a senior in college, so I was about 18, 19, 20 years old when I started, having a fascination with the markets, actually all the way back to when I was 8, 10, 12. I don't sound like it, but I'm originally from South Africa. And I remember my dad giving me the financial papers, and I would go up and down and look at the stocks. And then I remember in the 60s and 70s, even living in the US, I would go up and down the financial tables, and what a change. I mean, I remember, stocks that used to move an eighth or a quarter a day. A big move in a week was like 5/8 of a dollar. And now we have stocks that move $50 in a day. So it's just amazing to see, trying to remember where I came from and what's going on to today. But my training and my exposure to the markets really came, I'd say, my second year of college. I was going to one of the best business schools in the country, U.S. University of Southern California out in Los Angeles. It's a private school. And I was, taking all kind of finance and marketing courses. And one of the only really courses that I remember, from my time there was taught by this guy who was 89 years old. He had made a hell of a lot of money in the markets. He only took $1 from the school because he just wanted to give back and teach. I really understand that because that's basically what I do in my business here. And he was basically teaching us how to evaluate investments based on what we call fundamental analysis, where you break apart, a company, you look at the price earnings ratio, the turnover, the sales to inventory, all these metrics to try and decide on how to determine a value of a financial market or instrument. And that's called a fundamental analysis. And then coinciding with my education at USC, my dad was doing business with this investment banker named Graham Loving. Now, you couldn't make that name up. Graham was one of these idiosyncratic characters. He wore an eye patch over one eye, very quiet, very intellectual guy, kind of intimidating. And, he was, a phenomenal investment banker making a lot of money. But on the side, he was trading all of these exotic commodities markets, orange juice futures, cocoa, live cattle, soybean meal, treasury bonds. He was trading about 18 markets at one time. And this was at the height of a market that really we've never seen. I mean, even with what's going on now, we're talking about the late 1970s, where this was the first time gold went, from $200 to $1,000. Silver was at $50. It was seized by the Hunt brothers and, went to $50, and soybeans went over $1,000, and pork bellies and live cattle, and everything was running. And Graham was making money heads over tails, to the point where, my dad said, look, can I give you some money to trade for me? And so my dad put in $50,000, and Graham put in $450,000 into an account. And this was in 1979. So that was, money back then. And Graham took this $500,000 to $5 million in 1 year. And I had a front row seat to all of this because Graham would come over to dinner, and, I talked to him all the time, and he really liked me and took me under his wing. And so this was, just as a young man trying to figure out what to do with my life, this just opened my eyes to something that I could never envisage. But it wasn't only how much Graham was making. It was really how he was doing it that was really intriguing to me, because it was diametrically opposite to what my fancy private education, was, teaching me. Basically, Graham was only trading these things based on price. There's just no way you could understand the, fundamentals of the cocoa market or the orange juice market or the soybean market. And by the time you did, the thing would have moved. And so, and remember, this was the time before the internet, the time before fancy charting services and what have you. Graham basically took out a piece of graph paper, plotted out an X and Y axis, and put, price and time, for whatever he was trading. And every day he would just plot the closing prices of live hogs or soybean meal or pork bellies. And he'd say, Mark, I basically want to buy a market that's going up and sell a market that's going down. And after a while, these squiggly lines started to tell Graham a story, and he would basically trade on that. And to me, that was just fascinating. And that was the beginning of my education on what we call technical analysis, the analysis of an investment prospect solely based on price action. So I'm always get this question, do I trade the news? And then the short answer is no. The markets are ahead of the news. And I'll show you trade after trade after trade that I did this year to basically prove that. The markets are a discounting mechanism. So, if we could all trade the news, we'd just go downstairs, buy a Wall Street Journal, and we'd all be rich. But the markets don't work that way. The markets are ahead. They're a discounting mechanism. Whatever we think we're seeing now, the markets are looking at 3 months, 6 months, 9 months down the road. And so I only look at price action. And I'm going to show you a bunch of some previous trades, and we'll talk about, some markets that are going on right now. I'll look at the markets in real time. This is a real-time webinar, by the way. So many people ask, is this live, is what have you. This is real time. I'll be, going into the markets. and analyzing some trades in real time. And what I'm going to show you is my 4-step trade execution process. So every trade, doesn't matter what I'm looking at, oil, gold, the pound versus the yen, Tesla stock, whatever it is, to me, it all starts with a phase or a condition where either that market's going up or it's going down. And if it's, not going, up or down, it's going sideways. But there is another variation of the markets. Markets can be turning from up to down and down to up. And it's on the turn. That's where I make a lot of my money. I think Tesla is a company that's on the turn, a market that's on the turn, a market that's gone hugely higher. And now I think it's going to turn lower. And so, and then once I identify the phase or the condition, then I look at the pattern or the chart pattern, because once I feel comfortable that I understand what the pattern is, then I'll understand or feel comfortable with the future trajectory. So if we see these bullish price patterns, then, no matter what the price is showing me in the short term, I know to be faced north, look to buy that thing. And then I look at, certain daily price action to get me into a trade and tell me where the risk is. So it's a 4-step process that gets me closer and closer to the bullseye of a high value trade. Now, hopefully you should have been handed some collateral material, some packet before this webinar, basic understanding or information on price patterns. Did you do that? Hopefully my team should have sent you something before this webinar. If not, we'll make that available. But this assumes that you have some basic level understanding of of patterns, and just armed with 3, 4, half a dozen patterns, you can make an absolute fortune in the market. So let me kind of put some information to a lot of rhetoric, if you will. So some people teach. I actually trade. I'm an educator, but I'm a very active trader, as you will see. Right now, I have a giant position in the stock and the FX market. So these are my FX positions. I'm long the pound New Zealand dollar from a couple of weeks ago, and you'll see that I will stay in a trade if it's working for me. I am short gold. Short a couple positions of gold. I'm long the pound yen, and then recently I got long the pound Australian, and collectively, I'm up, over 100 grand right now. These are open positions. Tomorrow I could be down 100 grand. So that's the way it goes. And these are my stock positions. So right now I am short 2,950 shares of Tesla, and Tesla is, $1,000 a share. So this is a $3 million position. Now I got short Tesla at $1,150. So I'm sitting in profits in this particular account of $375,000. And I'm still sitting in it. Today, Tesla went $50 in my favor and came all the way back, but I'm still sitting in it. Whoops, I don't know what I just did. Sorry about that. In another account, I have 800 shares short, which is worth 860. So cumulatively, I have $4 million short this stock. Now, short means that you're positioned to take advantage of the downside. I'm not going to go into all these mechanics, but basically, it's the opposite of being long. And, and I've got 91,000. So between this one and this one, almost $500,000 in open profits. And then, if that weren't enough, I loaded up in the rally today. I bought some Tesla puts that expire at the end of the week. And this is very speculative. These puts are very expensive. They're very far out of the money. In this case, this is a 950 and this is a 920. So the stock would have to drop, $50 and $70 respectively to even, start making money. So kind of crazy bets there. But I think Tesla is one of these phases that maybe something crazy could happen, and we'll see. So those are my live positions today, FX and stock. I'm just going to show you kind of my thinking. So this is a format of an email that I send out every single day to those on our elite program. After this 4-day webinar series, if you're interested, our team will send you some information on our elite programs. Every day I send out these high value trade ideas And the idea is really to educate. So most people focus right here. What's the trade? Where do I get in? What's the thing? And what I'm trying to do is really show you what's going on here and explain it there. Really what goes on here, whether I make or lose, it doesn't really matter. I mean, my whole methodology is predicated on the possibility that I could lose 5 out of 6 trades and be a huge winner. It's completely upside down of everything you've been exposed to, because most people are looking at trades very, very short term. They're looking to take 7 pips out of the market, or 15 pips, or 20 pips. They're looking to, risk 20 pips, and that's just a mug's game. The only one that wins in those scenarios are the broker. And it's not my opinion. After 3 months, it's the statistics show that 90% of people lose their money. I think it's much, much more. So this is an example of an email that I sent out on November 22nd. It was Monday. And here was the chart with the explanation where I pointed out that it had an inverted head and shoulders bear price pattern. That actually should be a bull price pattern in the pound versus New Zealand. And I'll go to the live chart of the bull of pound New Zealand in a moment and show you what I'm talking about. And then I said penetration above today's inside day bar suggests there could be a chance of a healthy move higher from current levels. And that's exactly what happened. It's trading 400 pips higher right now. The buy stop was 92.77, and I believe this trade is trading considerably higher now. So you can see that I've got open profits in this trade of about 68,000 at some point today. So I got in at 192.78. It's trading at 196.51, and I'm just sitting in this thing. So, I didn't jump out after the first 50 pips. This, position was put on the 23rd, and I'm still sitting in this thing 2 weeks later. And I could be here for 2 months from now. This is a trade that I did in Moderna. I sold it at $342 and covered it at $288 and made $300,000 in 1 day. And here are my confirms. So, I try and verify everything. This is not a demo account, I assure you. This is real as a heart attack. This is my personal trading account. So you can see I shorted it right here at 342.55, and I bought to cover around 392, 288, etc. So I got out with a nice profit there. This is a company called OCGN. I bought it at in the $8 area, $9 area, and I blew out in the 15 and 16, and I made close to $1 million on that trade. This is a price chart of QuantumScape. Actually, I think I showed this on a webinar, one of these webinars where I said, I think right at this juncture, it was on one of these webinars right here, I think, where it made this reversal right here at $40. And on a webinar just like this, I said, this has nowhere to go but lower, and the thing just dropped out of bed from 40 down to 30, and then made a series of bear price patterns that I capitalized on all the way down. So here are my emails on QuantumScape, formed a head and shoulders bear price pattern. This is all the way back in April. And here are my confirms. I made 300 grand shorting QuantumScape. Here's 54,000 I made on a put option. A put option is just a very leveraged way of taking advantage of a slide in something. Here's more puts that I made more money on, etc. This is one of the biggest trades that I did this year, where I was very bearish on Beyond Meat, but there was an area where it kind of sprung a trap, which I thought was going to go the other way very quickly. And so I suggested to our members to put a buy stop at 120.5 because there was a bear trap here. And this thing ended up going to $160 in 3 days, and I made over 7 figures in 3 days. So here are the prop, bought 5,000 shares at 120.5. Here it was at 139. I was up 83,000. I was up $394,000 in these calls that I bought for $1.50. So here are these calls also. I bought the 125 and 126 call. I bought this for $1.50. They ended up going to $23. And I ended up making a ridiculous over 6 figures. I'm sorry, over 7 figures in just 3 days in BYND. Here was another setup in, sorry, I keep punching this button, but all right, we'll just look at this. This is gold. I was looking at gold in an ascending, broadening price pattern. I think it's still there. I predicted that gold was going to go to 1,700 at the time. It was trading at 1,867. I sent out an email in January to our members to sell gold at 1867 with an objective of 1,700. I then added to that trade with a sell limit at 1797. So I had 2 trades before this thing plummeted, and it did go to 1,700. It went to 1,680. Well, I took profits under 1,700 and made a nice load of money on those. So that's an example of how I look to extract the bigger moves out of the market. So I, look at the daily, weekly charts to extract the bigger moves. So my whole objective is not to, trade just for, 10 pips here or $1 here or $1 there. I'm trying to look at setups that are going to translate to bigger moves in the market. So, I started talking about the pound New Zealand. So once I just start there and kind of slowly explain to you, how I look at moves. Now, this one is kind of a more difficult one. Pound New Zealand is, an exotic beast to trade, but it's like anything else. What we're trying to do is, and that's what I love about trading. Trading is, we're like detectives. We're trying to detect where is the next move, where are the traps, and this chart is possibly one of the most intriguing. Now, I have been saying that this has been in a quiet bull market since late 2016. So you can see this is the British pound versus New Zealand dollar trading pair. Now, it really doesn't matter what this is. This could be corn, it could be IBM, it could be natural gas. It really doesn't matter what it is. I trade a picture. I trade price, and price tells me a story, either to get long, get short, and how to position my risk. So you can see in this particular juncture, pound New Zealand fell out of bed. It was just a straight down move. But trends do end, and when they end, they always put on some kind of pattern before they turn the other way. And you can see in late 2016 and early 2017, this thing started to put on a double bottom where it went to a low, pivoted off that low, retested the low. And when it comes through the neckline, then it basically confirms that this thing is reversing. So this is a market reversal price pattern. It's a double bottom. And with the word bottom in it, it informs us that the market has bottomed, right? So this is trading for dummies. Once I understand the market is bottomed, then it's basically going to do what? Over time. It's basically going to go higher over time. And so from late 2017, early 2007, late 2016 and early 2000, I was shouting from the mountaintops that this thing's reversing. This is going to be a huge move, and get ready. And then we had a rounding bottom here. And so this has been, the line in the sand. This 180 is held for many, many years. And while it doesn't look like it, it looks like we've just been in a very sideways trading thing. We've been in a quiet stealth bull market, which I think is going to continue and possibly ramp up very, very soon. So I'm long pound New Zealand, and there was a couple of buy signals all the way along. So you had a double bottom here, and then you had a little double bottom there, and then you came and retested this thing. So this is kind of like when it's an Eve and Adam double bottom. And Eve is a multiple attempts at one low, and Adam is one attempt. And this really won't be confirmed until here, but I do believe, based on the prior history, that we're going to get there. And then should we get to the 2000, I think that may not be an exaggeration for what you'll see in this pair. So I think that this is an enormous opportunity. To my mind, you can keep accumulating positions here. And I don't think I mean, a lot of the risk has been taken out. This thing has been treading water for a while. And I think if it starts picking up steam, it could really get going in a big way. But again, this one is a little bit less obvious because it's more of a sideways market. Typically, I don't like sideways markets, but there have been a host of kind of moves within the sideways thing that I've taken advantage of on the downside as well as the upside. And so in addition to the pattern, so you can see we have this double bottom price pattern. It looks just like the letter W. So that is a double bottom, and it's as simple as that. When we see these patterns, typically, and we did a whole scientific analysis, you'll see that for 100 days after that, the market effectively goes higher. Well, the market went a lot higher for a lot longer after that. And so this is what I look for. Once I understand this, then, you know, when it's doing all kinds of nonsense in here, I'm not really getting scared. In fact, when it's coming off, I'm buying it because I understand that this is a bottom. So eventually this will find its way higher. And so I look at a combination of the patterns. And then once I feel comfortable with the patterns, and then it kind of gets on its way and I'm trying to figure out, okay, how do I join this trade? Then I look for price action. When I look at price action, I look at what I call my insurance day bars. And I've coined them insurance day bars because to my mind, by definition, in my definition of an insurance day bar is a bar that both tells me where to join the momentum of a trade as well as how to assess the risk. So what is my definition of an insurance day bar? Basically, it's this. So when you see a bar that looks like this, that's what I call a key reversal, where you make a new low, and by the end of the day or the week, this is a weekly chart, you close at the high. And so when this thing made its double bottom all the way, and I need to get rid of all this clutter. Give me a moment. Because what I do is I look inside the pattern. So, you know, very often we see things forming, and if we can see certain days, I will jump on a trade, you know, well before it's confirmed. And what I mean is at this juncture, you saw this double bottom. Now, it really wasn't going to confirm until it broke out above this neckline. And the neckline is simply a line that is drawn through the pattern. So the confirmation really came there. But I was getting long right here, right there, and right there. Because if you look within this pattern, you can see that when this thing made an all-time low, by the end of the week, it closed 1,000 pips higher. Actually, that bar right there was pointing in the direction where this thing was going to go. Days, weeks, months, and years later, this thing made a new low right at this old low and closed at the high. Made a new low, closed at the high. Made a new low, closed at the high. So when I saw those three bars, that tells me that I have pretty good confidence. If I enter here, I understand where the risk is. If I get long here, then my risk is really under the, you know, I think there's very little. So what these reversals effectively tell me is that somebody else took the risk for me. Somebody else showed me where the bottom was. You could see that in this market, they took it a lot lower, and by the end, it closed on the high. And so that huge washout shows me where the risk is. Now, I don't just trade these, you know, key reversals in a vacuum. I look at it in connection with the pattern, the trend, and what have you. And you can see these key reversals right here. made a new low, close at the high, made a new low, close at the high. And again, you had another double bottom price pattern. So we get the confirmation in terms of the pattern and the price action. Now, the other, what I call insurance day bar, is what I call an inside day bar. And very simply, an inside day bar is exactly what it sounds like. The range from low to high sits within the range of the prior day. So the high and low of this day sits within the low and high of the previous day. And I don't particularly care where the inside day bar closes, because to me, what the inside day bar represents is that it's a coiling. It's a storing of energy. Sorry. It's basically building energy to go and unleash and uncork in the direction as indicated by the pattern and the trend. You can see there was a very small inside day bar here. Well, this is I'm sorry, not small. This is a weekly chart. So you can see in this week, you had this coiling, you had this move higher, and then you actually had two inside bars, because this bar here and this bar there both sat within the range of that bar 2 weeks earlier. So for 2 weeks, you basically were just uncoiling. You were just coiling and building this energy right here. You were just building this energy. And then you can see how the energy just uncorked in the direction of the pattern and the trend. And so it was a combination of understanding the pattern, the price action, how to join this trade and take advantage of a monster move. And I got out right here. This was on a Sunday night in January in the middle of the pandemic. This thing ran up 1,000 pips on a Sunday night. And I had a pending take profit about 211.87. It went to about 218. Is there any questions on that? So Bill says, why would the October 18th and November 19th be a double top? Not sure what you're recommending. You mean right here? Well, it was a double top for the time. So sometimes you get what I call counter trend moves, and you get these patterns and price action that indicates that you can get in on the opposite. So you can see that while this has been kind of going higher, there have been all kinds of times where this thing has gone a lot lower. And I have been short on those times. So even though I'm inherently bullish, there have been a whole bunch of times where this, shows a pattern, and then the pattern, yields like 800 pips to the other side, and I will take that. So you can see at this juncture, you had negative key reversal price action, made a new high, close on the low. Now that in and of itself wasn't enough, but what happened was this was trading within this ascending triangle price pattern. And I wasn't quite sure if that reversal was really going to reverse this whole thing, but once it started breaking back under here, then it alerted me that this was a bull trap and that there was going to be an opportunity here. And then if that wasn't enough, you had like a cliche where you did exactly the same thing right here. We had another ascending triangle. You had another key reversal, and I took it this way again. So I will take what I call counter trend plays. So to me, this looks like it's an up market. So all of these down moves are counter to, I think, what the main trend will be. This one's a little harder to see, but I use price as a weapon. I will go short, I'll go long, I'll use patterns, I'll use price action. And this is kind of a very complex example of that. It says, how do you have the stomach for all this volatility? Well, that is a good question. And, like today, I was short Tesla. I was short 4,000 shares and it went down $70. which means I was making $280,000 within half an hour of the close of the opening. And then the whole thing turned around. So, this game is not easy, but the thing is I held my position because I believe that the price action in Tesla is so negative that eventually this thing is going to, go down. So this is what Tesla looks like on a weekly basis. And right now so this is what I believe is a parabolic market, parabola, where it goes up so fast that it's likely to come down just as fast. There's a possibility of that. And so what I'm looking at on the daily is this. Let me put on a little bit more time. So this is like the pound New Zealand, where it broke out of something and then it broke back. And if it does that, it's going to go. So you can see that Tesla has had this huge, beautiful kind of uptrend line it was adhering to. And it formed this ascending triangle, and then it broke out here. And you went on this trot. But now there's a series of ominous looking price patterns here in the form of this triple top. And today we actually came through it and, closed back higher. So now I think to me, this was just a short covering rally that tomorrow we're likely to, start going back down again. At least I hope so. I mean, I got in right here at the turn at 1150. So I've got, a lot of cushion, and that's why I decided to sit through this, sell off. And, this is where it gets very complicated for a trader. And I knew I would be confronted with this thing where you have enormous profits. And now you don't know what, because I'm in here. And so if I get out here and take my profits, yes, it's a gigantic haul, and I will take it. But, to my mind, I'm thinking this thing could, come down here. And, it's like, where do you get back in? I don't know if I get back in with the size position I have. And so you go through all of these things. So I am just trying to stick objectively with what this pattern is telling me, or at least I think it is. So now this really, wasn't confirmed entirely. It came through the neckline, then closed higher. And so we kind of need to dribble lower. But I do believe that this thing is going to come back and retest this 800 breakout area. But it is a lot of volatility, and that is a good question. I just try and look at the big picture, and the way I handle the volatility is understanding the risks. So most people get into a trade and they think how much they're going to make. To my mind, the best trades that I took is understanding where my risk is. And if you can get in where the risk is very small, then it really lowers the, the battery acid in your stomach. And so I was actually long here. I saw this key reversal. I advised our members to get long, and I thought we were going to have one more push here. I thought I saw this double bottom, and then I thought we were going to get one more push. And I was long, and, kept going, higher. This day made a new high. That made a new high. And then the following day, it made a new high. But, I've learned to become very acutely. So to me, there's always a dance around the unchanged level. There's always kind of a cadence, how things open, what have you. So now there's always a possibility something gaps and, keeps going higher. But to my mind, the body of the previous bar, needs to be filled. And I'm much more comforted if I'm looking at, if I'm long, is for this thing to open lower and to go higher. But what happened in this particular day is that the market opened higher and then went slightly higher. And then I could see intraday, it was kind of doing this descending wedge. And then my whole thing is that if you come back and revisit this unchanged level, that constitutes what could be a reversal, where the market kind of goes higher. And then if it doesn't hold and comes back, now you've got the possibility of a reversal. And that's exactly what happened. So I first executed get out of my longs, and I made some good money on my longs. And then I decided that I'm just going to try getting short. And the way I rationalized that was, and I play all of these games with risk and reward evaluations. So the market went up there and started to come back down. And so I went short here on the basis that if it took out the high, that I was going to get out. So effectively, this was my risk. So I got in right here. That was my risk. I mean, that much for that kind of reward. So that's how I, kind of validates myself. That's, how I was getting. So I basically got this on the turn as this thing was rotating through unchanged. So you can see the unchanged is right in the middle. This left thing was the open. So it opened higher and then it started to come back down to unchanged. And so I got in right around 1150, and my risk in my mind was $20. 1172 was the high. And so I, got short on the premise that I'm going to risk 20 bucks for what is now, making 150 bucks on this trade. I was making 200 this morning. And I think I could be making a lot more. So to me, trading and handling this volatility, it's all about understanding your risk. Now, the problem is where we are now, people will say, well, so if you get in now, the risk is pretty indefinite. It's all of this. It could, go here. It could do anything. What I like to do is see price action that tells me where my risk is. So let's, take, for example, tomorrow we see an inside day bar. Maybe we have another one the following day. So now you have these things where it's starting to coil, just the opposite of that pound New Zealand, where you build some energy. So first off, you got to understand the cards that you're holding. So I'm starting off with a premise that this is a triple top. And with the word top in it, to my mind, you're going to go lower. So now I'm looking for ways to go lower, but, I also have to understand my risk. And, because this thing has come off so hard, so quickly, the risk is not really that determined. So the disciplined thing to do is kind of wait, see how this thing sorts out, and then understand your risk. So let's assume that this is what we see in 2 days. We get these inside day bars. Basically, the way I handle this is I'd slip a sell stop pending order underneath that low. I put my stop loss there. That's my risk, and that's my reward. So I always try and set up a trade with at least a 3-to-1 risk reward. So that means, if I'm looking at an FX trade and I'm looking to risk 50 pips, I want to see at least 150 pip outcome. So I will not trade an FX pair unless I can see a path to making 150 pips. Now, most people who, go on my review website say, before they met me, they've never made 100 pips in their life. And that's because everything you're being taught, all of these expert advisors and all of these things are nonsense. They're trading for 5 pips or 7 pips and trying to do it 10 times a day. And there's just no way to consistently make money on that. So what I'm trying to do is, I saw this breakout. I am trying to take a piece out of the middle. So I knew this thing was going to go higher. I might not get in the beginning. I might not get out the top. I'm trying to take a piece of the middle out of a big. So 850 to 1,050 is 200 bucks. I am just trying to take a piece of the middle out of that. And I got in right here, and I think that this thing is going to go on a huge ride lower. But the point is, if I can set up a trade with a 3-to-1, meaning that if I got short here at 1150 and I was going to risk 25 bucks, I had to see a $75 outcome. And right now I've got about 150, 140. And if you set up your trades with a 3-to-1 risk reward, you can actually lose 72% of your trades. That's just the math. So most people focus on, the winning percentage. Are they winning most of their trades? And by doing that, you're actually missing the point, because this game is not about being right. It's being, right at certain times and making your winners far bigger than your losers. So in this scenario, I could easily send you 5 losing trades in a row. And on the 6th, make up for all of this and then some. I just look for big game. Now, in this trade, I'm looking for big game, but I'll take 150 pips out of a market. I'll take 300. I'll take 450. In this pound New Zealand trade, I think I can take 700, 800, 1,000 pips out of that trade. So this is the premise. So we have 4 days together. I'm going to go over trades. I'm going to try and reinforce what I do, but it's pattern, price action, execution. And so again, once I understand what the pattern is and which way I need to get faced, then I look for a way to get in this thing. And the way I look for it is what I call my insurance day bar, either an inside day bar or a key reversal. And then if I see that, basically I layer it with an execution plan that requires me to confirm it. So if I put a pending order, a sell stop there, and the market goes basically straight up, this is never triggered. I require the market to go through there and actually confirm it. And then if I'm wrong, I've got, some kind of stop loss, up there or somewhere on the other side of it. And so now I'm setting up a trade where this is my risk and this is what I'm looking for. And if I can justify it, I'll take that trade. And I don't need to win every time. In fact, I don't need to win majority of the times. Excuse me. So does that make sense? Does this resonate with you in terms of, does it make sense? So again, what I'm looking at, this is a daily chart where each one of these price bars is 24 hours, or I'm looking at weekly charts or monthly charts. And people will inevitably ask me, well, can't I look at this on an hourly chart? And yeah, you can, and you will see this on an hourly chart, but it won't have the same ramifications. They'll go down here and then it'll be up there. And you won't understand why. So why I'm looking at these larger time frames is that I'm trying to understand the cards that I'm holding. If you look at a 15-minute chart, this is probably going to look really bullish. Tesla will probably look really bullish on a 15-minute chart. Looks like it's making a double bottom here, so you can't understand what's going on here. And so what I want to do is sort out the forest for the trees. The more information, so I'll peel out from the monthly, then I'll go to the weekly, then I'll go to the daily, whatever that can help me see what the long game is. Now, sometimes you may be in a monthly bull trend and in a short-term downtrend, there could be, certain conflicts. But I always want to understand what is the main game here, and get in sync with that. And so I look at a combination of patterns and trend to tell me where, so this has been in an uptrend, but now this pattern starts telling me that this uptrend may be reversing. So I really want to kind of just focus mainly on the methodology. I know you guys will ask me to, look at 100 charts. And really what I want to do is focus on the methodology and your questions around it. So Alex says, when trading on such big time frames, don't your stops end up miles away sometimes when it decreases your... So I gave you an example of how I put in a trade right here at 11.50 with a $20 stop right there. And I did that because I saw this peak here and that peak there. So it was in context with something where I started getting in my water, a feeling that, we could have a reversal here. Now, typically I wait for the reversal to occur. This was just one of those whims. But in this case, you can see that on this particular day, we went to a new high and then close on a low. but it was right in context with a major resistance right here. So now, forget that I caught it right on the turn. Let's just say you saw it right here. You see this key reversal. So the way I'm going to handle this is I'm going to put a sell stop right underneath that low, and then put a stop loss somewhere, out of the way, and let this thing go. And you can see, even since that close, we've been just going lower. So this is an example of this key reversal, this reversal. This is the using that price action to understand where to get in, where to, so I don't have to take, a $200 risk, a 200, so I know if I get in there, I've got a pretty small risk if I'm right that this thing is about to turn. And, it basically went up a little bit that day. And I probably, if you use that, it would have clicked you in and you would have never seen anything against you. So to me, trading should be effortless. The market should just put you in. You shouldn't have to stare at the screen. So if you sneak your pending order in here, let me use a color that, whatever. You put your pending order there. So what happens the next day, thing opens higher. And, if it keeps going higher, then no harm, no foul. You're not triggered and no big deal. But in this case, you don't have to stare at your screen and figure out, when it's going to, go over the moving average or, violate that. You basically put your pending order under that key reversal low and let the market do all the work. So in this case, it opened higher, came around, put you in, and now you've never seen one tick against you. And that to me is, what trading should do. It should be effortless. Yes, you can put a stop loss on options. So Daniel says, how do you know the amount of your account to put in a trade? Good question. So I always advise that you shouldn't put any more than 2% in a trade. If you really like something, you should never put more than 2%. You can always build your position. My whole mentality is if this thing keeps going in my favor, I'm going to keep adding to my position. I actually, when this thing rallied today, I bought some puts. So my idea is that, I'm always looking to add. So you can start off with a base position. And then if the market validates what you're looking, you can always add to your account. So I, told our members to buy pound New Zealand 400 pips ago. I would say you could buy more here and keep building that position. So, I'd say that you shouldn't start with anything more than 2%. In FX, which is more leverage or whatever, or if you're not really sure of what you're doing, really, you shouldn't do anything more than 0.5% a trade. And I'm going to talk about risk management tomorrow. I'm going to actually show you a risk calculator that you can use in the FX market to know exactly the size of your position. And unfortunately, in the stock market, you're going to have to make that calculation. So let's say we have a $50 stock and you want to know, how much you want to put on this trade. And you really like it. So you want to take a 2% bet. Well, 2% of $50 is what, $100? My math is terrible. So now this is your risk that you want to risk in money. And let's say you want to, buy this thing at $50 and you think you might have to have a $3 risk. $3 risk, right? So you're going to risk to $47 to see this thing go to $75, what have you. So you divide that $3 into the 100, and now you can buy about 33 shares. And if you put a $3 risk on 33 shares, you're going to lose $100 or 2% of your. Actually, you know what? That was not correct, right? So I was equating the market price to the account price. So you have to start with okay, whatever is in your account. Let's say you have $5,000. This is what your account size is. Now you want to take a 2% risk. I knew there was something wrong with that. And that equals $100, right? So this, you start off with understanding what do you have in your account and what do you want to risk. So you start out with 5,000, you understand you want to risk 2%, you want to risk 1%, it'd be $50. And so once you understand your risk, then you say, okay, this is my trade. I think I have a $3 risk. In order to risk $100, how many shares can I? And so you can buy 33 shares. And if you lose on your $3 risk, you're going to lose $100 or 2% of your 5,000. So tomorrow, Christopher, I will show you a risk calculator that you can use on every trade to come up with exactly what the size of your position is. So many people are picking an arbitrary position size and they're choosing a position size that's too big. And the way they justify it is that I'm only going to take a 10%, a 10 pip risk or a 20 pip risk or what have you. The problem with that is that you can die a death of 1,000 paper cuts. So even though you think you're being a good boy and putting a 10 pip, stop loss, pound New Zealand, goes up and down 300 pips a day. How are you going to try and control that with a 20 pip stop loss? So you end up just being stopped out a lot of times and bleeding to death, a death by 1,000 razor cuts. So instead, what I do is I put my stop loss 50, 80, 150 pips away. And people say, well, I can never take 150 pip risk on a trade. Well, I'm going to show you how you can. All you have to do is dial back the size of your position. So if you want to take advantage of these monster trades, you have to give them room to trade. If you're looking for a 500 pip move in the pound New Zealand, does it make sense that you can capture that move, with a 15 pip stop loss? It doesn't. And it does. And that's why, and that's why people always get intimidated, thinking that you have to have a huge account to take advantage of these big moves. No, you don't. It's all about risk. Whether you have a $500 account or a $5,000 account or a $50,000 account, 1% of 50,000 is the same as 1% of 5,000 is the same as 1% of 500. It's 1%. It's all about scaling and making your position sizes correct and giving yourself room to take advantage of the bigger trades. And unless you catch these bigger trades, very unlikely you're going to make money just duking it out, trying to take, dollars, in and out every day, So Mike says, I have 5 shares of Tesla at 11.90. Did you buy it? If you bought it, yeah, you should get the hell out. Now they allow you certainly in the United States, you can buy fractional shares. So Tesla is $1,000 a share, but if you have a small account, you could buy 1 share or 10 shares or what have you through fractional shares. In FX, you can do micro lots. You have to find a broker that does that, or mini lots, whatever. But I'll go through FX tomorrow. So I'm not going to look at a whole bunch of charts right now. I want to kind of get across this methodology. Trying to, give you a basic premise and understanding of how I look at markets. And I don't care what that market is. To me, price is the news. I don't look at, television or, forums or my friends or what have you. To me, everything that I need to make, I just made $500,000 in this trade. And I'm looking at nothing more than what you're seeing. So this is what's called a clean or a naked chart, because there's no volume, there's no MACD, There's no moving averages. There's no nothing but price and time. This is what I learned from Graham. And I just look at a clean chart. A picture tells me 1,000 words. Does your stop loss cover news flashes? Yeah, if you get stopped out, you get stopped out on some news, then you get stopped out. Irving says, does the last daily bar look like key reversal? So this is what I say, you can't really look at, reversals in a vacuum. So this is a key reversal. Today is a key reversal. And maybe I should be scared by this. Made a new low and closed on the high. Then I say to myself, is it going to go straight up through all of this? So this is what the market is like a magician, right? Magician doesn't just walk on the stage and pull a rabbit out of the hat. Walks on stage and then he's distracting you and doing all kinds of things with his right hand while he then pulls the rabbit out of the hat with the left hand. And so you kind of have to understand what is distraction and what is real. And to me, this is what I'm looking at. This is what I'm looking at. So I'm looking at a pattern that tells me a top has been put in. This is a triple top. And so with the word top in it, what does it mean? It means that the market's going to go down. Now, do markets go straight down? I mean, this thing went from 1150 all the way to 950. So that's pretty straight down. Markets need a break. And so it's like an elastic band. You pull back on, you create new energy so that it can go again. And I think all that is this is building new energy to go back down. I could be wrong, but I've got a pretty good cushion in here, and it sucks to watch $70 get taken out of your account today in profits. But I'm looking for a bigger move here. And so yes, this is a key reversal, but this is to my mind the distraction. You have to understand what's real and what is. And I could be wrong. I mean, this could start building price, and we could start seeing this thing go back up. And that could be a reversal that sends it higher. So there is, a neighborhood here. There's a double bottom here, and now you got this. But now you got this cadence of lower lows, lower highs. So look, I think this thing is topped. I took fortunately, I've got in with a nice cushion. I got in all the way up here. So, I can. Murray says, so you never use TradeLink stop loss to give you a long trade. So yes, I do. I give my, but I don't want to squelch this trade. This thing could go all the way back to 1,070 and still, come off. There's a lot of room now. And so right now it's a little bit more unpredictable. I like to get trades where, I understand the risk reward and then it's very favorable. So if you look all the way here, you had these rising lows. You had what was looking like an ascending triangle. And then all the way up here, made a new low, close on the high, made a new low, close on the high, made a new low, close on the high, made a new low, close. So when you see these reversals, you could have bought in here, risking there. So you had a very small risk for a very big upside. So this is what I mean by finding areas where the risk reward is so favorable. This is much more difficult right now because you've had such an extreme move. You need to kind of see the let the market settle out and give you some more information. Right now, I can't tell you where the risk is. It's pretty wide. I mean, I kind of feel like we topped out today. We went to 1,021. I feel like you're going to go back down tomorrow. At least I hope that's the case. But it's much more difficult now because you made a $200 move in 4 days, whereas here you were kind of just incrementally building. And so the risk reward scenarios were easier to assess. And that's why in my daily email today, I sent out, I'm going to wait for the market to settle out before I can see risk reward trades again. Laurie says, do stocks fill gaps? Everything fills gaps, but you shouldn't trade that way. This gap was left a long time ago. And if you're still waiting for that to be filled, you're going to lose a lot of money in the interim. So you should not trade based on gaps. But I do think that gap will be filled. I do. But maybe I'm just talking my own book. At what point do you abandon a trade if it pulls back? Well, every trade is different, so that's hard to answer. So, like I said, when I got in right here, if it had, taken out the high, I would have gotten out. So it all depends where you are in the trade, where you are in the maturity of the trade. So, I see this as a bear pattern, and at some point this thing could be, down here, and there's going to be a point to get out, wait for a pullback, so it depends where you are in a trade. And when do you abandon something? So if you think you see a double bottom and then, the thing starts, doing that, then, that didn't work out. So the market does throw you patterns all the time. And, basically what I do is I just draw my structure around prices, and then I see how the market moves within that structure. And that's been really my growth and my maturity, because you'll see patterns all the time. You'll see, textbook patterns. So here was a double top, head and shoulders. And for a while, this thing, gave you a pretty good move, but it wasn't this wasn't a top, usually right at, double top is usually the top, and this still had more legs to go. So, I started seeing the rising, lows here, and figured out there was going to be one more blast. So you see patterns all the time, and you can play these patterns. Look, this breakdown from 800, went all the way down to, 500. So you see patterns all the time. You can play them for what they are, but this is kind of realizing what is the big picture. That was a bear pattern in a bull market. Now I think this whole bull market is going to be in question, and we're going to start rolling the other way. And, if I'm right, then every time it rallies, I'm going to short it. Before, every time it sold off, you had to buy it. So I think now we're going to be in the opposite. So Yashin says, how do we choose the graphs to look at? Is it by instinct, based on news? I don't know. You haven't been listening. I don't look at the news at all. I just look at this. Whatever chart you're looking at, all I look at is price. So Alex says, do you see an advantage using bar charts over candle charts? And so, maybe it's just, a lot of people use candles, but to me, let me just dial this in a little bit more. I just see bars they stand out. Candles, they obscure, to my mind, what's going on. But to me, this stands out very clearly. I can just step back and look at this and see this right at this juncture. So when I look at this, it resonates. And frankly, the best trades are if you just open up a chart and it just speaks to you. It just tells you something. So what this chart is telling me is you have this kind of even atom or triple top or what have you. So you have a top here, you have a top here. And then within the tops are all these reversals, made a new high, close on the low. So you made a new, this is subtle, but I can see these reversals and, within the cadence. So once I see the pattern, then I see the reversal, then, I can see that what this is, telling me. Now, I think this reversal is going to be a fake out. I don't think you're going to see a follow through from that. I think this is the pattern that's governing. And once you see a pattern, and then for 100 days after that, you should see a trajectory from that pattern. Now, conversely, here are all of these bar chart reversals that I saw here. Here's that double bottom. But there's not only a double bottom, it was how it closed. Made a new low, close at the high. Made a new low, close at the high. So those things stand out to me so starkly. When I look at a candlestick, it's all just, I can't make that out. So I use bar charts. It's a personal preference. Whatever floats your boat, works. But to me, when I see makes a new high and closes on the low, right in this pattern, that tells me something. That creates for me a risk-reward relationship where I can sneak in a sell stop right underneath this key reversal and understand where my risk and reward is. So I use bar charts, and I use a collection of patterns, price action, and then I layer it with an execution to confirm what I'm looking at. Now, in the case of this, right now, like I said, it's just too difficult. It's made its pattern. I think based on that pattern, you should short the rallies. And that's what I'm doing. Jay-Z says, is it fair to say that in time of volatility, the risk reward ratio will be greatly affected? Well, not really. So I did a trade. So I have a session that I do in the morning called the Boiler Room. And last Wednesday, before the earnings in this company, I shorted and I executed that trade, and I can possibly go and find it in my broker station here. Let's see if I can try and find it. I like to validate what I'm saying, but basically there are people on this, who will back me up. So where did I dock you? I shorted DocuSign at right here. So this was last Wednesday. And I actually shorted a bunch more than this. But I did that on this morning. I shorted DocuSign at $245.91, DOC, sold short. This was last Wednesday. This was in the time of this great volatility that you had last week. But to me, again, this came down to risk and reward. And it came to an area where I understood the risk so well. So I felt very comfortable no matter what the volatility. So to me, what I was looking at with DocuSign was, first off, I was seeing this double top. And once I, like Tesla, once I see the pattern translates into trajectory. And in this case, it sure did. Then I saw another double top and a head and shoulders. Looks just like a man or woman's head and shoulders price pattern. So the combination of these two very bearish price patterns said that this thing is going to go down, just like I'm seeing in Tesla. Now, we never know what the cadence is. So, this said that this was going to go down, but for several weeks, it went sideways after that. But then we saw the ramifications of what that pattern meant. But it was right here that I put on this trade. So you saw this little interim double bottom right here, these two peaks right there. But it was also the price action, this key reversal price action. Made a new high, close on the low. Made a new high, close on the low. So it was in this session right here, and you saw it. I shorted a 249 in front of 50 people on my thing right there. So I surmised that we had this reversal here. When the market pulled back in the early morning, I just sold into it at 250, and I got out at 160. I made $90 in 2 days. And so this was in an era of phenomenal volatility last week. But what I did was I found a trade where I could identify the risk and reward. It was so small. I knew that if I could get in here 250, here was my risk at 260. So this was my risk, and that was my reward. So trading is all about understanding risk. If you can quantify or find a trade where the risk is so small, and sometimes I'll find these trades where I feel like I have almost no risk, When I was on a webinar like this and I was shorting QuantumScape, I said, you have no risk in this trade. And it went down 30% right after that webinar. So there are certain times, and this is where you have to wait for the market to come to you. You can't chase it. So like Tesla, like now, is in a very indeterminate thing. I think you could short the rally, or you could short it here. I'm pretty comfortable that what you're looking at in Tesla is what you're looking at this. Pattern dictates trajectory. And I think the pattern in Tesla has shown you that it's topped. The only question is it going to go through all this kind of junk before it goes down? And that's a great possibility. But this is what you need to be focused on, not this. This is the magician's distraction. This is the rabbit being pulled out of the hat. All right, I'm going to leave it there, give you something to noodle on overnight. We'll pick it up tomorrow at 4:30 Eastern time. I hope that, this Bruce says, opening on Tesla, should I open on a day trade or a week? Well, I'm taking a bigger time frame on this. So I don't know when these things are going to go. All I know is that tells me something's going to go in the favor that I'm positioned. Alex says, loved it. Thanks a lot. All right, guys, I'll see you back 4:30 Eastern time tomorrow, and we'll talk about risk management some more. Until then, I hope you have a healthy and prosperous trading day, and I'll see you tomorrow. Thanks, Dwight.
All right, no problem.
Thank you.